I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000 when the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold. Silver, for whatever reason, perhaps it's lower unit cost, it travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. And honestly, Mike, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled.
Right.
I have real fears, not hopes, fears that the gold market will triple.
Gold prices have risen nearly 5% in the last week, approaching its all-time high of $2,074.88 per ounce as investors flock to the safe haven asset with the conflict between Israel and Hamas escalating. The price of gold reached its all-time high in August 2020 during the peak of the COVID-19 pandemic, which was another event that rattled markets and sent investors running for safe havens. Rick Rule, the president and CEO of Rule Investment, is concerned that gold and silver will see substantial price increases. This concern is driven by the fact that gold historically performs well during economic uncertainty when people are worried about the value of their savings in U.S. dollars. Investors often prefer the relative safety and calm of the precious metal over the volatility of stocks when times are tough. For instance, gold went from $253 to $1,900 over 10 years in the past. While the price of gold has performed well this year and gained 16% over the last 12 months, it has started to climb since war broke out in the Middle East. Domestically, gold's price has also been boosted by expectations that the U.S. Federal Reserve will hold off on raising interest rates at its next meeting on November 1st. Rick Rule regards gold as insurance while viewing silver as an investment with the potential for short-term gains rather than long-term stability. As gold gains momentum, silver often follows suit, typically exhibiting more substantial and rapid price movements. Rule also highlights that the precious metals market, including gold and silver, represents an extremely small fraction of total savings and investment assets in the United States, less than half of 1%. If concerns about factors like quantitative easing, debt, deficits, and negative real interest rates were to become more widespread in the U.S. economy, and if the market share of precious metals were to return to historical averages, around 2%, this would lead to a quadrupling of demand for these assets in the United States. We will bring you clips from Rick Rule's interview with Mike Maloney. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I am afraid that gold and silver are headed much higher. I say afraid because,
right.
To be completely honest, I'm old and fat and rich. Gold does well during periods of time when people's concern about the maintenance of their savings in U.S. dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad times. Afraid you're right, too. I got a lot of questions at this conference I was just at about, will gold break through 2,000? I don't care. I don't own it because it would go from $1,925,000 to $2,050. I own it because of the lessons that we learned in 2000, where it went from $253 over 10 years to $1,900. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. I certainly don't have the preponderance of my net worth in gold, just like I don't have the preponderance of my net worth in any insurance product. Gold to me is an insurance product. Now, I will admit, on occasion, I speculate as opposed to invest in silver. I do that because in my experience, when the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold, silver, for whatever reason, perhaps it's lower unit cost, travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. I'm a credit guy, really.
Yeah.
The market share of precious metals and precious metals related investments, securities, stuff like that, gold stocks, comprise less than one half of 1% of total savings and investment assets in the United States. as Robert Friedland would say, a pimple on an elephant's behind. The 2-decade mean market share of precious metals among U.S. savings and investment assets is 2%. So if concern about quantitative easing, debt and deficits, negative real interest rates became a little more broadly spread in the U.S. economy, and if the market share of precious metals returned to mean, I'm not talking about crushing the bond market, I'm talking about returning to mean, demand for precious metals and precious metals related assets in the United States would quadruple. And that's precisely what I think is going to happen. All we need is reversion to mean. Reversion to mean quadruples demand in a market that's 22% of the world's savings and investment assets.
The banking turmoil that unfolded in March 2023 marked a significant systemic crisis reminiscent of the scale and scope of the Great Financial Crisis. While the bank failures had unique triggers, they collectively ignited a crisis of confidence in the resilience of banks, banking systems, and financial markets worldwide. This turmoil highlights a problematic strategy some banks pursue, aiming to profit from interest rate differentials by borrowing short-term and lending long-term. However, the inherent risk arises when these banks borrow at a fixed rate in the short term and lend at a floating rate in the long term, making them vulnerable to interest rate fluctuations. Substantial increases in interest rates threatened their profitability. Rick Rule emphasizes Silicon Valley Bank, First Republic Bank, and Bank of America as institutions that faced funding difficulties due to these practices. He cites these examples to underscore the need for vigilance. Additionally, he points out a regulatory aspect where authorities permit banks to carry long-term bonds on their balance sheets without marking them to market if the banks claim the intent to hold these assets until maturity. However, this practice can obscure the actual value of these assets, potentially exacerbating the challenges faced by banks in the financial system.
I think what you say is worth paying attention to. You know, banking, Mike, done right by mature adults, is a really good business. I mean, it's really, really, really a good business. You focus on customer service with your savers. You focus on reducing your cost so that you can pass some of the benefits of that to the depositors. You aggregate the deposits and you lend them prudently. You do something for the savers that they couldn't do for themselves. It's really a good business, and it is by nature a leveraged business. The problem is that too many bankers take the attributes of that business to an illogical extreme. The Fed considers a bank with a 7% equity slice to be well capitalized. I'm an old guy now. I've been in banking 40-something years, and I know that sort of 1 or 2 years out of 10, as a banker, you're confronted with some truly ugly surprises. That's the way it works. So the arithmetic that makes sense to me is that 10% is a much better number than 7%. Banks are supposed to have some money in them, equity in them. And we seem to have forgotten about that in the United States. And then there's this problem called duration risk. One of the ways that the unwise in banking make money is that they borrow in the near term and they lend in the long term, and they try and arbitrage those two. The difficulty with that is that if you borrow in the near term on a fixed rate and you lend, at a floating rate, and you lend in the long term at a fixed rate, an increase in interest rates wipes out your business. Some of you will remember the savings and loan business. That's what went wrong. There wasn't a catastrophic decline in real estate prices. There were people that experienced funding difficulties where they had long-term assets and no access to funds in the long term. And that's what happened to Silicon Valley Bank. It's what happened to First Republic Bank. It's what happened to Bank of America's earnings last quarter. In truth, people need to pay attention to their banks. They need to obtain something called the Statement of Financial Condition, which the bank must give you. And the accounting is very, very, very tricky. The regulators allow banks to hold long-term bonds on their balance sheet if they say that they're holding them to maturity with no mark to market, which is to say, if a bank holds a 30-year bond that was bought in a period where a 30-year bond would yield 2, and now the 30-year bond yields 4.5, so the capitalized value of the bond has fallen by half, the bank is allowed to carry that bond on their balance sheet at par. Silicon Valley Bank, when they experienced their liquidity crisis, when they had problems, and they had a different problem, another problem, concentration of funding. When the overnight funding began to go away and they had to sell their bond portfolio, they had to sell the good part first. All the stuff that was floating rate and near term, there was a market for. There was a bid. They sold it and they got cash. All they had left over was the underwater bonds. People need to pay attention to that. Depositors need to pay attention to the solvency of their institutions. Investors need to pay attention to whether or not the institution is run by sober adults. And borrowers, too, need to do business with banks that will be there to meet their funding needs 4 years from now or 5 years from now. Just do a little work. Don't trust the big thinkers to do your work for you. And that spills over into the broad economy.
Gold prices are poised to rise further due to ongoing economic uncertainties, attracting investors seeking stability. This trend could increase demand in the precious metals market, cementing gold's status as a haven. What are your thoughts on the price movements of gold and amp silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.